Welcome to Bloomberg Markets. I'm Sonali Basak. The S&P 500 is having the best week of the year as earnings take center stage and traders breathe a sigh of relief from the latest inflation data. Let's get a quick check on the markets here. The S&P 500 is notching a gain. We are looking at the S&P moving higher, really up, snapping weeks of declines, one of the worst weeks we've seen in a while. The Nasdaq 100 now up 1.6%, and the Philadelphia Semiconductor Index really up a fair amount today, 2.2%. What was interesting about that is just how much green you see on the screen, even with some negativity around Intel today. Bitcoin taking a small leg lower, about 1.6% heading into the weekend. Let's look at cross assets too. The bond market is really interesting today. You see the 2-year yield fluctuating all day, but around 4.98 on the day. You saw it touch almost 5% this week. We didn't quite get there. Muted moves right now, but a lot of volatility intraday. The 10-year yield around 4.66, just under 4.67. That hit around 470 earlier in the week as well. You're still seeing a move of about 3 to 4 basis points now, and the U.S. dollar is still on the rise, and the yen has been weakening quite drastically. We'll talk about that more throughout the day. Now let's look at some movers on the equity side, because of course, tons of earnings. You have Google parent Alphabet soaring past a $2 trillion valuation after first quarter revenue that beat expectations, with artificial intelligence boosting growth in the cloud business. Analysts welcome the company's new dividend and an additional $70 billion buyback. And Microsoft seeing its biggest jump of the year after showing signs that AI is fueling growth and demand. Analysts were positive about strong commercial bookings and growth at its Azure cloud unit. Now, inflation, we've been talking about it, showed little signs of letting up in March, with core PCE rising slightly faster than anticipated. Bloomberg's Michael McKee joins me with more on the PCE and also consumer confidence. How do we think about both things going on at the same time?
Well, the Fed might be more interested in a way in the consumer confidence numbers because they ask people what they think inflation is going to be. And one-year expectations did rise to 3.1%, up from what it was last month. And the 5 to 10 year was unchanged. So there's still some relative confidence, but a little bit slips as people look forward on inflation. Looking backwards, the PCE numbers better than expected, but worse than expected, in the sense that they came in as expected, which was good news to a market that was worrying about what might happen after yesterday's quarterly number was much higher than anticipated. Instead, came in as expected, 0.3 for the core, 0.3 for the headline, and then incomes and spending were both up more than anticipated. So the bottom line, basically, Sonali, is that the economy is still strong, and it doesn't look like inflation's going down. Not really rising, but not going down. So Fed going to be on hold.
Now, I also want to talk about this Wall Street Journal report, this idea that Donald Trump's allies are quietly drafting proposals here that could erode the Fed's independence, including a long shot policy that the president should play or not play a role in setting interest rates here. What is the conversation around this now? Who would be in support of something like this, breaking with a very long-standing tradition on something that would, frankly, really overhaul the way we think about the economy and the Fed's role in it?
Well, there are some very conservative Republicans who would probably go along with it, but outside of the Trump campaign, not many other people would think it's a good idea. Now, we have to point out, this is based on anonymous sources. We don't know who they are. They didn't even know for sure whether Donald Trump was aware of this effort. Obviously, he had no love for Jay Powell when he was in office, so it's plausible. But the idea that the president should participate in any kind of monetary policy making would really upset Wall Street, global Wall Street, because then you bring in the idea of politics, and you look at what happened in Turkey when Erdogan decided to decide where interest rates should go. So it's probably a non-starter, but as with just about everything Donald Trump, you can't be sure.
Mike, we thank you so much for keeping an eye on all the possibilities here on what's ahead. Now, we're going to talk more about that inflation data because Wells Fargo senior economist Sarah House joins me now on this. And if you look at what we got this morning, was there anything that made you think differently about how you think the bond market can progress from here?
Yeah, so I think what we learned today is maybe inflation in the first quarter wasn't quite as bad as feared in terms of momentum really picking up in March. So we saw in terms of why the Q1 numbers annualized came in so much hotter yesterday was really more a function of January inflation being revised higher. So I think there's some good news there is that we didn't see a big pickup in momentum towards the end of the quarter, but when you step back, you're still seeing core PCE at a 4.4% annualized rate over the past 3 months. And that tells us that inflation, it is going to be rather stubborn in terms of coming down over the course of this year.
How did you think about this in the vein of the consumer confidence data as well? How problematic is it that consumers are frustrated with the stickiness of inflation, even if they didn't see a big boost ahead? The current level at which we stand right now, how that might impact expectations and behavior for that matter?
So I think overall, just the stubbornness of inflation, I think it is very much tied to the fact that you have seen consumer confidence and sentiment really just move sideways this year as consumers haven't gotten as much relief on the inflation front as they were beginning to see last year. And I think also as we get into a later stage of this inflation fight, the realization from consumers that prices are not going to actually go back down to anywhere near what they saw in 2019. And really even just the pace of price growth still remains pretty hot. So I think that's weighing on consumer confidence, but at the same time that doesn't seem to be deterring spending as we saw in some of the other numbers this morning.
When does it deter spending? You see really mixed data from the credit card and banking communities here in terms of just how much weakness there is in the consumer. The spending information has stayed pretty strong so far, but what would cause it to crack?
Yeah, so what I think about when I'm looking at the path for consumer spending really comes down to what's the outlook for real disposable income growth, particularly as we're getting further away from all the fiscal support that we saw through COVID that allowed consumers to spend even as inflation was raging and you saw a big collapse in real disposable income around 2022. And we're returning more to those fundamentals, which means really the strength of the jobs market, where it goes from here. But with expectations that the jobs market is likely to slow, we think we'll see a slowdown in real disposable income growth, especially as you're just not seeing as much improvement on the inflation front. And I think we're already seeing a taste of that when you look at the year-over-year rate of real disposable income growth. We saw that sink to really the lowest we saw since late 2022. So that's going to be a constraint on spending, I think, much more than what we're seeing in terms of just how consumers are feeling about the economy.
It's a good time to set us up for jobs data next week. Sarah, what do you think would be the biggest kind of place that there could be the most variability here? Is it wages because of what you're saying? This idea that it's not just the jobs that you're seeing in the market, it's what people are making out of them.
Right. So the thing that's helped real disposable income growth has been the fact that we're still adding so many jobs, and we think we'll see another pretty robust print here next Friday, probably somewhere around the order of 250,000. So not quite as good as what we saw in March, but still very, very healthy. But as you're seeing wage growth slow, that is going to also be a limiting factor on just how fast income growth can continue to rise. And from there, we are expecting some further moderation in the trend in average hourly earnings. So even if you get another 0.3% in terms of the month-over-month reading, that would bring the year-over-year down to 4%. So basically the slowest pace that we've seen since mid-2021. So you are seeing some downward pressure in terms of the jobs market and wages, even as you're still continuing to see really robust headcount hiring.
Sarah, what do you need to hear from the Fed next week in light of their meeting?
Yeah, so I think we'll really be listening for any clues in terms of what that rate path looks like. We're not going to get a summary of economic projections, but I think that we'll almost have to see Powell come out rather hawkish, just given how sticky inflation has been in the first quarter here. And so I think we could see that in terms of the statement. Maybe they make some adjustments around their recent characterization of inflation, but I think a lot of it's just going to have to be teased out through the press conference in terms of what the Fed needs to see to regain what was some budding confidence about the path of inflation ahead.
Wells Fargo senior economist Sarah House, we thank you so much. Happy Friday to you. Have a great weekend. Of course, it's been a very busy week of economic data and another busy one ahead. But coming up on this show, we're going to talk about Intel because it's been dropping on a lackluster outlook for the chip maker. It is against the grain when it comes to tech stocks today, and it is our stock of the hour. We'll talk about that next. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak, and it's time now for the stock of the hour. Intel still struggling to return to the top tier of the chip industry. Sales in the second quarter will be about $13 billion, below analyst estimates. And today, it is the biggest laggard in the S&P 500 and the only laggard in the Philadelphia Semiconductor Index. Of course, one is the loneliest number I believe that you'll ever see. Earlier, CEO Pat Gelsinger did speak to Bloomberg about those results. Here's what he had to say.
Obviously, hey, we delivered a solid Q1, right? We met on revenue. We, beat on earnings. A bit tepid in the first half, as we said, but we see a lot of, improvement as we go through the year. And with that, obviously, the foundry business, as I would say, we're going to see progress on the foundry business every quarter from now to the end of the decade.
Bloomberg Technology co-host Ed Ludlow joins me now, and Ed, it begs the question raises the question, I get in trouble for saying it that way, on why they are such a standout here in terms of performance.
Because the story is a turnaround plan, and the turnaround plan has been in process for a number of years, and it's not yet showing fruition. And that's really the question the street has. Intel's really interesting among chip makers because it has products, largely CPUs that go into personal computers, but also CPUs, GPUs for data center. And at the same time, it wants to have a foundry business, or in other words, a contract manufacturing business where it builds semiconductors for others, much like TSMC does. But the reality is, Sonali, if I took you anywhere around the world where Intel has a fab or a facility, and I took you inside and show you what they're not making anything for third parties yet, just for themselves. So they're kind of stuck in this moment where neither part of the business is where we're promised it should be.
Stuck is a nice word because if you see the stock reaction, clearly Intel's management has not portrayed its story to investors yet that can signal when that turnaround would be. What do investors really need to hear from them at this point?
Yeah, it's basically name-dropping customers and then showing evidence that those customers show up in the financials, on the foundry side at least. And you just heard the soundbite from Gelsinger. He's promising we will see progress every quarter through the end of the decade. On the product side, there is signs of progress, right? Particularly in AI PC chips, where they are going to exceed their previous guide of 40 million units this year. But if you think about the story of our lifetime, probably, AI accelerators or AI GPUs, the reality of it is this. Intel is telling us this year they will make around $500 million on Gaudi, their AI accelerator. AMD, which has only just come out with its latest generation MI300, will do $3.5 billion this year. And NVIDIA, which we all know about, it has a $40 billion top-line market for its AI accelerator. So that $500 million from Intel shows you how far they still have to go to catch up in what is the most important market in the server and data center context right now.
Are they just too far behind on the AI story at the moment?
The difficulty is those two arms of the business, right? Foundry and making foundry profitable is a really difficult exercise. It requires a lot of cost in the first instance. And the problem is, because they're not doing well on the product side, that's where they need to make money to then pass over to the business. They talk about like this $50 billion backlog of business. They have some names out there like Microsoft that they will make chips for. But it's a backlog because it's not yet real. These are technologies on the production side that don't come into force next year. So it's continuing to wait, and every quarter is a similar story. Like many CEOs, the message from Gelsinger is just trust me and bear with me. It's coming.
We will bear with you, Ed, and I hope you're bearing with everybody else, and have a great weekend ahead. That is Bloomberg Technologies' Ed Ludlow. Very busy week for that man, and of course more tech earnings next week as well. Now, coming up today's Wall Street Beat, we're going to go to the mining industry because Elliott boosts its stake in Anglo American after the miner dropped a takeover bid from BHP. We'll talk about that next. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak, and it's time now for the Wall Street Beat. Today we're looking at Blackstone because the company has set a goal to grow its total credit assets to $1 trillion in the next decade. And to do so, they've made sweeping changes atop the unit. Bloomberg's Danny Berger had an exclusive sit-down with Gilles Delarte, the new head of credit and insurance over at Blackstone.
Ultimately, what we do, we're always going to coexist with banks. We're great partners to them. You saw us announce in Q1 a number of partnerships with Barclays, with KeyBank, real win-win situations where what we brought to the table was highly complementary, solved a need for them. And I think you're going to see us do more of those types of partnerships.
But it can't all be buddy-buddy. You're competing with them at the same time.
There might be situations, but for the most part, look, we borrow from them. We pay them a lot of fees. We see opportunities from them, and we source risk from them at large still. Certain borrowers will sometimes come to us directly, and that's what you'll see, and that's what I think ourselves, as well as some of our competitors, have gone through. But ultimately, we don't think that this is a model where one needs to beat out the other. There's enough opportunity to finance broadly defined all these markets and coexist with one another in a very structured and constructive way.
So the IMF wrote a paper earlier this month, and you will not be unfamiliar with their hypothesis at all. The idea being that private credit remains untested, but untested in its current size. And not necessarily that it poses a systematic risk, but to the individual investors who've invested in perhaps a bit more risky, but over-leveraged and illiquid and non-transparent type assets. Do they have a point?
Look, I would say we probably see it slightly nuanced or different way. Lending in itself is not a risky thing. If you have the right protections and you do the right the loan level underwriting work. Our performance ultimately speaks. If you look at our default rates, we've seen zero default so far this year in our private credit portfolio over the last 12 months. In our non-investment grade portfolio, where we finance over 2,000 companies, we've seen less than 40 basis points. That's a fraction, 90% lower than what you see in the public market. So if you have the right expertise and you position your book defensively, and that's what we've done into this cycle and this environment, you can persist. You may see some bifurcation of performance, and you've started to see a little bit maybe early in Q1 in some of the BDCs. You've seen some slightly more elevated default performance in the lower middle market. Where you invest ultimately matters. And so our focus has been, we like to finance large companies that are better positioned to weather the cycle. We like to finance them in sectors that have strong tailwinds, where there's strong growth, high free cash flow generation, sectors like software, business services, the energy transition or renewable energy arena. And if you do that well and stay away from things that are maybe more capital intensive or cyclical in this part of the environment, then you build a resilient portfolio, and that's what we've done.
That was Gilles Delarte of Blackstone with Bloomberg's Danny Berger in his first interview since taking the role. Now, activist investor Elliott, we're going to talk about them now because they have built a roughly $1 billion stake in Anglo American. People with knowledge of the matter have told Bloomberg. And this adds pressure on the British miner after it rejected a takeover from Australia's BHP, which reportedly Elliott is going short. We're going to talk about this now with Crystal Say, who reported on the stake. She joins me now. And Crystal, you also had broken the deal news as well, along with our team here at Bloomberg. What's the latest? Why does Elliott have this positioning now?
Yeah, so the Elliott news came today, this morning, that they have about $1 billion worth of stock in the company. That puts them in the top 10 shareholder. What exactly are they pushing for, especially in the context of the BHP approach? It's still unclear. We're still we're still doing more reporting on it. But it's clear that when an activist comes in, they do believe that the company would be undervalued. So it wouldn't be surprising if they think that there are more to be unlocked within Anglo American. So it's an interesting story, and it's really, they're not the only investor that has shown up. There are other investors that have spoken out. Bluebell has also amassed a stake in Anglo American, and there are other investors that are speaking out against this BHP deal, which was rebuffed.
How do you think through Anglo American BHP as it stands right now, given that you had followed this deal to the deal talks and the reported outcome of that, and everything that's happened since then and the resistance against this deal, how do you explain what the state of play is?
I think for such a big deal, this would sit at about $40 billion. For such a big deal, there's always going to be multiple steps in negotiation. So the BHP approach, it's an all-stock approach, and that had been rejected. It would be interesting to see whether this draws out other potential buyers, as well as with the pressure that Elliott and Bluebell and some of the other existing shareholders are applying. It could push Anglo American to either figure out something strategically internally or to entertain some other bids. So it's a fluid situation, but by far I think a lot of people in the market are saying that this is just the beginning and not the end.
Well, explain some of these scenarios. We only have less than a minute here, but how do you think about how the road ahead looks and whether this particular deal can come back on the table?
Yeah, well, what really would require from now on from the BHP side, it's really the ball is in their court now. The BHP would either have to come up with a better price or how negotiate the deal differently. Like I said, it was an all-stock offer, so if they would come back with a cash offer or something slightly different. But again, this whole deal is going to be a huge consolidation in the mining industry. And the mining industry has a lot of other big players that have been gunning for assets, especially for copper. So whether other will come in, this would be the biggest thing that we're watching.
Crystal Say, amazing work this week. Of course, that would have been the largest deal of the year, and now large investors hanging around the bend. Now we are looking at a week here that you're ending the S&P 500 back in the green. Big tech saves the day here, even with a sell-off in the bond market. More markets coverage ahead. Busy day this Friday. I'm Sonali Basak. That does it for today. This is Bloomberg.